S&P 500 gapped down on some news out of Apple, which we'll address, crushing technology stocks. And then as the day progressed, we saw something really positive. We saw buying across not only technology, but financials. We're going to discuss that. We're going to look at this chart and discuss how it shows clearly that somebody is massively out of position. But was the Apple news that bad? What about the deposits that came out of financials? Why was FRC able to hold its ground today? We're going to address that and several other stocks that we need to watch for tomorrow ahead of CPI on Wednesday. Let's get to it. Hey everybody, welcome back. We have a lot of ground to cover. In this video, we're going to go through today's news, what to expect on the week, what stocks are moving, where the inflows are going, and why somebody is really massively out of position. Either large institutions or the smaller hedge funds, but somebody's way off base here, and we're going to get into that and what it means for the market. So we're just going to start with me, Captain Obvious, and obviously this is a dragonfly pattern on the S&P futures. It's an extremely powerful pattern. If you can flip that, we should probably tend to push. Now, whether or not we're going to do that ahead of the CPI that is supposed to come out on Wednesday, that remains to be seen. But that pattern is definitely there. We definitely made a higher high from the previous day close. It is irrefutable no matter how you want to look at it. And this happened on the heels of some really bad news. And that's what's really important about this. We had some really bad news today and the market just blew it off. IDC came out and stated that PC sales are off by 40%. And that's kind of an issue for the company, Apple. Stock opened, ran down, reversed by the end of the day and formed a hammer. So how much of this is factored in? That's what we're going to have to look at. How much of what they're saying is actually factored in, because we closed at the high of the day. One of the key statements I like to make in the market: if you have really bad news, which this was, and your stock goes up, you have bullish sentiment. That means a lot of it's already baked in. If this dropped on the news, then obviously it's not baked in. It's clearly baked into the numbers at this point. And I think that's very telling. I posted this on Twitter and I'm just going to walk through it. To me, this looks like one enormous bull flag that's getting ready to break out. I don't know if it happens or if it doesn't happen. I do know people are completely out of position here, and we're going to get into that. But I think that we need to really look at this and go, why aren't we breaking down? This would be a perfect day to break down. Instead, the entire sector rallied. The entire technology sector rallied today and closed at the highs. Now, there's no data that's coming out tomorrow, so there's no reason that this had to happen, right? It could have just sold off. You could say, oh, well, they want to be, flat going into the CPI number on Wednesday. And guess what? It's not Wednesday, so they have time, and it didn't matter. They closed. Now, this was pretty fascinating to me. Now, the number one thing that keeps bull markets alive, or markets going higher, however you'd like to refer to this, I would just take a look at this level right in here and see on this XLC. And we're all expecting this to fall apart. And guess what it does? Closes at the high. You're in the middle of the range. Now, I'm not crazy about that for a couple reasons. The S&P is higher and my sector is not higher. I like to be the sector that's leading. So where did the money go to today if it didn't go into XLC or XLK? Rotation, rotation, rotation. Now you are rotating directly into the semiconductors again, which is exactly what you want to see. You're going from the mega caps, from the Apples and the Microsofts of the world, then you're rotating into semiconductors. Everybody thinks semis are done. Look on social media how many people are telling you to short semiconductors right now. This is the type of stuff that you start to see when you are really forming bottoms. And whether or not this is the bottom that holds, or whether or not we someday roll back in 6 months and retest those October lows, I have absolutely no idea. But someone's going to have to explain to me this part. What is going to get the market down? So if FRC blowing up, and let's be really clear about this, FRC is in a lot of trouble. If you're cutting your preferred dividend rate, you have to think about it from this perspective, right? You're down 90%. Nobody wants to buy your stock. Nobody wants to inject you with a capital infusion unless they're forced to by the government at this point. Nobody wants to do a secondary on your positions. It tells you everything you need to know, and the stock's flat. This is a matter of time before they're just going to have some major problems. It's very obvious where this is going. Once you lose trust as a bank, which would be the de facto standard if you're cutting your dividend payments, not just in the common, but in the preferred, who has no voting shares whatsoever, you've lost all credibility. So this is not an if, this is a when this runs in and does some kind of reorganization or some kind of spinoff. I don't know how it plays out. I doubt highly at this point it's some kind of merger. We would have seen that, but we're blowing this off and we're saying that it's contained to some regional banks and maybe it's one or two more, but it's not spreading. Now you're seeing JP Morgan go flat, but this is one we traded today, Schwab. You're seeing that certain names are starting to rally. You're starting to see certain names be rewarded. And I think that's really important. So if we come here and take a look at Schwab, look at this level. This was our first close on Schwab above the 8. I like it. And there was a day trade that we did right in here and it worked out fairly well and it just continues to push. This is really interesting to me. It's also interesting what Samsung did today, cutting output and chips, and then how Micron responded to that. So what we're seeing here is we're seeing companies position themselves differently and then other companies benefiting from that. So the FRC news, for example, let me walk you through where I'm going with this. So the FRC news is bad. The fact that the stock is here is shocking to me because I just don't see how they're going to stay in existence like this. It's just, I just don't understand it. So they're going to have an issue, and there's an issue out there. At the same time, Schwab comes out, issues some statements, says, hey, we're going to do this and that, and we're going to have this conference in a couple weeks. Everything's fine. And we're starting to see the FHLB slow down. So people are getting excited about that. But we're not seeing enormous moves to the upside. But we are starting to see certain names that were once bottoming and people were scared of. We are starting to see those kinds of names turn here, like Schwab and Goldman Sachs. Well, that's good. Then you drill into the XLF and look at the whole sector. That doesn't look great. You're just kind of bouncing around in here. I'm going to take that 8 and we're just going to make that a 5 so we can just drill into some of these a little bit closer and say, okay, well, we're barely getting above that 5, but how are we doing on the regional banks? And then you drill in the regional banks and go, well, we're barely getting above that 5, but there's this little divergence that's going on. In front of you is XLF Financials relative performance to KRE, and we can see it's at all-time highs right now. So the general financial names are outperforming the regional banks. This is a weekly chart going back about 20 years. Now, if we drill into the data, we'll notice a couple things. The very first thing we'll notice if we go back to a daily chart and just zoom in on what's going now, and we're not doing it just to measure the magnitude of the move, but to see if the move is tired, see where we are on a performance basis. So on a performance basis, we can see that we made the higher high here. At the same time, we can see that the RSI spiked up here and now is down. So this is what you call a negative divergence. So what this means is that we're going to put ourselves in a position here where XLF is no longer going to outperform KRE at the same magnitude, which means that they're going to start trading more and more in tandem. So you can expect KRE to actually go up and XLF to stay flat at the same time, or KRE to outperform XLF over a short period of time is what this is telling us. We'll see if it happens or not, but I think this is pretty interesting that the last 3 days here have been red on this. So this is something we want to pay attention to. So why are we not seeing this fall apart, FRC? I'm just going to be blunt. I don't have a good reason for you. I really don't. And I don't think anyone's going to buy them. I don't think anyone's going to be allowed to buy them because of the size. I'm wondering if they're going to split up the pieces like they did with First Citizens, and that's what everybody's getting excited about because they're going to get pieces of that. My play on this has always been NYCB. And that's the one that I think is going to benefit the most here, and we just haven't really seen that kind of move out of it yet. So let's see if I'm right on that or not. But so we understand what's going on in the financial space, and we know that if we look at the SOXX and we can see how we're wedged in right here, well, we can see what's going on exactly, right? So we can see that level right here, and we can see how we're making a higher high. And even though the Nasdaq did not really make that, oomph like we had today in the SOXX, this sure did. Now, this is where it gets really interesting. Over here, overlaid on top of the SOXX, I have the U.S. semi and semi equipment manufacturing, the aggregate long-short ratio of hedge funds. Goldman Sachs' prime book, you have hedge funds, large institutions, and this goes back to 2019. And right now they were, if you start taking a look by mid-December, I would say actually, let's call it September, they started being net short semis. Well, that didn't really work out for them, right? If you start taking a look at where they were really the shortest, it was probably the low of the market. And then they start rallying. Now they're starting to get net short again. So right now we have large funds that prime their assets at Goldman that are net short, or the longest long-short ratio that you've had in about 4 years. So they're massively out of position with semiconductors. Now, how is that going to go if semiconductors start lifting here? People are looking at that and saying it's bearish. I'm saying that I think it's going both ways. I'm not so sure it's bearish. If semis lift here, then it's not going to be bearish because it's going to feed upon itself. They're going to have to rush in and buy. They're not going to have a choice. They can't continually underperform the market. Okay, and everyone's saying it's only 4 stocks right now that are moving, or 5 stocks are driving the whole market. That's pretty inaccurate, and I'm going to explain why that's inaccurate in a moment here. But if you take a look at how we're moving here and how we're turning, right, and we haven't even gotten off the ground yet here with the RSI, but you hit 50 again, you did not crack, and you've been unable to crack 50, which is a sign of strength, right? So if you can't crack and stay below 50, that's where you want to be. It just means you're building up again before you get overbought. And all we did here so far was what? Work off an overbought condition. That's all we've done. We had a negative divergence here. You can see it. And all we've done is work it off. That's all that's happened here on this index. And you can see that in the names today. So NVIDIA, for example, today, when we were playing around with this and looking at names off the open, let's zoom in on this. It became increasingly clear what was going to move today. It was the ones that were beaten down the most. So when we saw this with NVIDIA, and then you can just see the W right here, and then the lift, and then that was it. And the thought process was, well, at a minimum, you're going to gap fill at an absolute minimum. And you had your little gap fill, and then you just pushed to that 275 level, which is a pretty glaring level, right? I mean, that's pretty obvious why you're going to stop up here. I'll just draw it in so you can all see it. So that's what happened. And again, here we are, and I'm watching social media, and I'm watching everybody talk about, oh, it's time to start shorting semiconductors. Well, how's that going? It's not going very well, right? I mean, if you were shorting these when they're breaking down, it's not working. What's working is buying the dip. Whether you want to admit it or not, when these things are breaking down and you're waiting an hour or two, it's working. So for example, here you are, you're breaking down, right, at the beginning of the day. An hour later is the low. You're breaking down in the beginning of the day. That's the low within a half hour. Here you are again, breaking down, and then it's rallying. Who moves in the first half hour of the market? It's retail. And you just can go through this over and over again. Tuesday, March 28th, down, bottoms in within 45 minutes. It's not always going to be like that. If everything always worked the same way, life would be very easy. But when you start going through this and you see the same pattern replicating itself over and over again with retail selling off the open and institutions buying into the close. Now, before we go into names, I just want to point out a couple things. If you're not looking at support and resistance right now, you're doing yourself a disservice. So this was a really clear indication for us today. We broke 13, and it was real clear when we were on the live call this morning in the room. I just said, do not go long, or do not think about going long until you get it back over 13. And then very, very clearly, we got above 13, came down, tested, came down again, tested, reversed. And that was pretty much it. And then we just bought TQQ right in here, and we did fairly well with it. I mean, I think it was like we had about 20 cents of risk in the TQQ trade. You could have done options or futures, whatever you're comfortable with. But if I map out the TQQ and then you look at this, I think it was 5-to-1 risk versus reward on the trade. I mean, now we're even up after hours for those that are still in it. So for us, it was right in here. It was that 35.16. So we were risking, let's call it 20 cents with slippage, and we pulled $1 out. So it's 5-to-1. It was worth doing that. Look at how we held VWAP today. Who buys at VWAP? Besides your little short-term traders that were all doing it and whacking it around, it's institutions. They just put their orders out and go, hey, if we get near VWAP today, buy X amount of shares, right? So you're seeing that support there as well. That's going to lead us to the next chart. Now, we've been going over this chart now for about 2 months. And I've been pointing out what I think is glaringly obvious. And this is the last hour of trading. And essentially what they do is they figure out a score for the last hour of trading as the last hour feeds upon itself, +1, so that's why it keeps going higher. And if the last hour is lower, then it sells off. The last hour, look at what's happening. Now, the last time you had a breakout like this was more of a breakdown, wasn't it? And it was back here, and it was November 2021. So somebody is massively out of position. And what do I mean by that? To start with, if we're in a position where we know that when you're selling down like this and you're breaking this level right here, we can all see that break right there, right? And then you kind of correlate that with what happened up here, where you're falling off a cliff and at the same time, the S&P is going higher. Well, you know you're setting up, because if institutions stop buying, the market's not going higher. I'll say that again. If institutions stop buying, the market is not going higher. Retail can help, but and this is why we always convert the smart money, dumb money. But what you need is some kind of breakout, right? So, and it doesn't happen right away. And I want to be real clear about that. It doesn't have to happen right away. Retail can carry the ball for a little bit, and that's what it did here. But now you start getting this, right? So now you have this little break right here of this channel, and you can see the push up. It might take some time here, but net, you have some institutions that are buying in the last hour, but they are massively out of position. So in other words, you have some funds that are doing that in the last hour. All that means is the last hour is going up on an aggregate basis, right? Net, that's all it means. It doesn't show you the inflows. So you're out of position with people putting a lot of money to work in the last hour, and you're still short tech as a result here on US semiconductor equipments on a multi-year low. It doesn't make any sense. So where I'm going with this is somebody's going to get hurt. Now, it could be the people that are buying at the last hour, right? They could get hurt because the market comes in, or it could be the people that are net short or don't have any semiconductor exposure. But somebody is setting up to get hurt, and this market's setting up for an extremely volatile move one way or another. So we're all aware that the move here was not great at all, right? Really bad, very, very bad report. We're going to have to dig into it. We're going to have to listen to what the investment banks have to say about it tomorrow, but really bad report. But what are we seeing happen on that bad report? We're seeing Bitcoin break out. So we're seeing risk on trades break out. This is an enormous flag, and you're breaking out of that enormous flag. We talked about this months ago when FTX was blowing up and saying, if this isn't going to take it out, what will? And you can see from back here, you're up about 100% from the FTX blow up. If that's not going to take it out, I don't see what is. So at this point, you're breaking out again here, guys. And you're seeing that in the names. So in other words, not only seeing Bitcoin break out, you're seeing them start to buy the names. So they're starting to buy coin, and that's starting to set up. MSTR, caveat, I have a position in this, and I actually added to it today. But if you look at this, I mean, this is about as clear as it can get. It's absolutely glaring that this is setting up a multi-year base here at this point, setting up to break out of it. So, and go and take a look when you get a chance at who the new larger institutional holders are of this. You'll be surprised to see that it's now some investment banks that have new positions that they are taking in MicroStrategies. So we know that Coinbase is holding. We know that Bitcoin's breaking out. We know that people are going to start trading it again. So we know that this is going on, right? We know the FRC news, and that didn't do anything to the market. We come in today, and then Meta's supposed to break down. And what does Meta do, right? We take a look at Meta. Let's get rid of my line right here. And we have a doji sitting right there. And you would call that a long shadow because of the way the bar is. It's not the top, so you're not really going to call it a dragonfly. But nonetheless, it's a bearish pattern, right? Because wicks are what? Price rejection. So at the end of the day, we're down $1 in Meta after this move. You're down $1. Okay, this is telling you everything you need to know going into Wednesday on how people are starting to position themselves at the end of the day versus how they're positioning themselves in the beginning of the day. But again, I'm going to preface this as we go through some of these. Somebody's going to get hurt, and I'll give you an example. So here's move, right? We're watching financials rally today. And at the same time financials are rally, we're watching the move index off the open. Everyone's buying protection again. Now, it's not where you were on Thursday. It's obviously lower. But for the whole day, people were just buying protection. So what do they know? Why are they buying protection? It's a really good question. And frankly, I don't have the answer to it. But I am watching this very closely because there's a huge divergence here that we went over in Saturday's video. And I'll link Saturday's video at the end. I'd strongly suggest you watch it if you haven't, because the divergence between the VIX and MOVE is telling you once again, somebody's going to get hurt here. And I don't know what side it is. I have my bet that it's that you want to be long. That's just how my head works right now. But I want to go through this because this is absolutely glaring. And one of the key things that I keep hearing about from people that really don't understand what's going on is that, oh, the breadth is bad. It's only 5 stocks that are, rallying, and they're the ones that are lifting the entire market. Well, this is the Nasdaq 100 200-day average, meaning stocks above the 200-day moving average. Now, for our purposes, I'm just going to put this in a line graph so that you can see it, and it'll make it much prettier, right? Very easy to see. What are we marking here? And what are we going to mark here? Well, we're going to mark exactly when you were here on a percentage basis of stocks that were above the 200-day moving average. You can see the levels that you were at right here, right? And you can see where you're at right here. Okay, so just so we're clear, since October, for people that are not getting this, the Nasdaq 100 stocks in October was 9%. Now you're at 70% of all stocks in the Nasdaq 100 are above their 200-day moving average. Okay, you might not be hitting new highs, and that's really where you are in the pecking order here, because you're not going to see those new highs, and you're not going to see that, quote, breadth, because these stocks were so beaten down. It takes a while for it to start registering like that for the New York Stock Exchange new highs, new lows. But when you start digging into this number and you start looking at this, it is very clear what's going on here, and that the breadth is much stronger, and this move is much stronger than anybody thinks it is. So this is where my head is. This is how I'm positioning myself. I don't know what happens with CPI. It could be higher, it could be lower. I really don't know, but this is the Nasdaq NDX with this. And I just want to point out and be obvious, okay? Here's your peak right here. And then if we come and look at the peak right here, and then you come over and we look at the peak right here, okay? And then if we look at the peak here to here. So what we'll do is we'll just take a look at where we're at right now. And I think this is somewhat important. Let me just clean that off because that'll bother me. But I think this is somewhat important. And no, it's not a direct correlation, but if you take from this peak over to this peak, right? And you just drop a line and you go, okay, well, where are we? Okay, you're 20% off on the Nasdaq 100 still from when we were at this level of breadth. Okay, I'm not suggesting that that is one major reason and the only reason why we should be higher. But what I'm telling you is it's telling you that we're going higher. Right? It might not be going up 20%, but you're not going to have the same breadth underneath the market lifting on a 200-day moving average. By May or June, you're going to start having names that are going to start being in a position where they're going to get way over that 52-week moving average. And everyone's going to be looking at their IBD and going, oh, this is at a 52-week high. That's at a 52-week high. And they're going to get involved. That's what's going to wind up happening here. Now, we're going to drill into some other names, but I want to leave you with this. And it's the same thing I said on the live call this morning to our community. Be careful of developing this mindset where you're going to be short for the rest of your life because you missed this bottom in October, where every drop is a reason that you should now be a short seller, okay? The game changes. The game is constantly changing, and this is how people wind up staying bears. Just a fact. Now, let's drill into some of these names and look at what's going on out there. Now, let me just clean up my lines. We went over this once, but I think it's really important to just kind of say, hey, by the way, not only did we make a higher high, we gap filled. So are we going to go over that? Now, my sense is that we came up, came down, hit a new high, did the retest, and we're probably going to take out new highs. Someone else is going to look at this chart, and this is why I love the stock market. Someone else is going to look at this chart and go, oh, you're never getting up to here. And that's what I love to hear, right? That's over. It's going to roll here. So imagine looking at this and not calling the bottom, but now you're going to call the top, right? How'd that go last time when it was down here, right? Now you're going to call the top. So if you didn't call the bottom, you're probably not going to call the top on a stock. Okay, no one cares about the PE. That's not why stocks are moving. Stocks move based upon technical analysis, and they move based upon demand. And I just outlined the demand, which is irrefutable for semiconductors and how out of position on a multi-year basis hedge funds and institutions are for semiconductors. Now, if you drill into this, again, not everything is rosy. That's obvious. Here you are in the Nasdaq S&P coming straight across, and you can see your level right here, and you're unable to break through that level, right? So this is still an issue for us. We're still having trouble here getting that outperformance, and we're banging our head here. And we want the outperformance because that's what leads to longer bull market runs, and that's what we're looking for. So if we take take a breath and we just look at things like that, you'll also find some other things that are overlaying to me that I think are just absolutely glaring. Like another one was Tesla today. Now, we were talking about this one again this morning and just going, you don't want to be shorting it. Don't be that guy. Here you are again in the morning, right? Half hour and then boom, that's the low. Half hour, then that's the low. I mean, it's not every day that it's going to do it, right? It's not every day. It's not that clean. But when you start seeing it happen, start paying attention, because all they're doing is taking stock out of the hands of retail and buying in the last hour. And they're doing it over and over again. Don't be retail. You don't want to be that person. But you're also seeing special situations that are playing out perfectly where people are scared. I've been talking about this name for some time. We got in this on a trade in the mid 80s, 87, I want to say, or 86, somewhere around there. And it's still misunderstood. It's not a merger of equals, and I still think this has room to go. But you're seeing a lot of things like this where people are just afraid to put money to work because they're scared. And I'll give you another one that we traded 3 times. And, the parties always end with these where they start getting tighter and tighter. But this is still getting bought at $7.50. $7.50 a share, the last 34% of shares outstanding. The person that owns 64% of the shares in their limited partnership, I think they're going to vote for themselves, to be honest with you. So I think this is pretty much a done deal and something I would look at. One final thing that I would take away from this is taking a look at XLY versus XLP. We rallied today. We made a higher high. Well, these things are breaking out. So why are they breaking out? And I think that adds to the confusion. I think it adds to the confusion where you have these people that are so heck bent on the SOXX breaking and so net short the SOXX that they're still putting money to work in the defensive names. And I think that that's really important for us to understand. If you're struggling with day trading, please watch this video. I've got nothing but great reviews on it. I have another one coming out on Sunday about a trade that I did. People are asking to see actual live trades that I did, or some of the people that I coached, some of the trades that they're doing. So I am working on that. Your comments are appreciated. Let me know how these can be better. Have a good night, everyone.